IKS Health, a very strong set is what the company has reported in. Over 30% of margins is what they have clocked in the quarter gone by. But what's the way forward? Let's listen out from Sachin K. Gupta, founder and CEO, as well as Nithya Balasubramanian, Chief Financial Officer of IKS Health, in conversation with Nikunj Dalmia.
Well, now for a quarterly chat with the top management of IKS, and for that it gives me great pleasure to bring on board Sachin K. Gupta, founder and CEO, and Nithya Balasubramanian, Chief Financial Officer. Sachin, Nithya, always a pleasure to have you back on ET Now. Thank you for joining us. For the quarter gone by, I can only see good things. Quarter-on-quarter growth, 10%, EBITDA margins impressive, PAT again impressive. When world is falling apart for the IT services industry, why is IKS growing? Are you different? Are you doing something unique, or you should not be clubbed into IT services? What is the secret sauce here?
Good morning, Nikunj. Thank you for having us. I think a solid performance this quarter. And really, Nikunj, I think, like you said, very different business than the IT services business. This is really an AI-enabled platform that is taking away chore tasks from healthcare providers in the US so that they can focus on the core task of patient care and reduce cost of care and improve quality of care. And given that we orchestrate this entire thing in a model where we get paid as a percentage of our customers' revenue, we don't get paid by the task that we deliver or the transaction that we process. What happens is, as a result of that, anytime we are able to replace humans that do the task with the proprietary technology that we continue to develop, which has now been evidenced over the last several years, we are able to then accrue the benefits of that to our bottom line. So one is the nature of the model itself, which is outcome-based. And second, because our model is built around driving efficiency in non-discretionary spend, the reality is the kind of pressure US healthcare is facing as it relates to inflating costs and reducing reimbursement, anything that can drive efficiency actually is going to grow. I was actually also commenting earlier on the earnings call, there's been $45 billion of equity investment in healthcare IT in the US over the last 4 years. That is a reflection of the fact that this $225 billion TAM that we are addressing, of which only $30 billion has been outsourced so far, is actually a really, really robustly growing opportunity set. And I think, given that we are leaders in this marketplace, our performance this quarter is just a reflection of our leadership and our continued strength of execution.
So, Sachin, those who are watching the show, can I safely say that, folks, IKS is IT, but it is a healthcare enabling platform which essentially has a very different model, and they are growing because US has to bring healthcare costs down, and because US has to bring the healthcare down, IKS is in the right place at the right time with the right talent, and that is the reason why they are growing. And don't compare it with IT companies or traditional IT companies. Can I say that, Sachin?
I think 100%. That would be an absolutely accurate characterization of our business model.
Nithya, for IKS to see the advantage of operating leverage, I think is visible. Margins have gone up from 20% or 20 to 21% to 31%. How has that happened? What is the story here?
Yeah, so because I think typically what's been evident in our business is that there are two vectors that drive the margin improvement. One is in our traditional business that we always had at IKS. We have a track record of constantly reducing human task or human involvement in the task that we do for the providers by constantly building technology and replacing the humans through technology. So that obviously leads to margin accretion. And the second level of margin accretion has been in this acquisition that we did about 18 months ago called Acuity, that had a model where they were doing all of the tasks in a very US-based, human-led execution model. And there we've been able to replace a lot of that US humans with our proprietary tech, supervised with our offshore-based humans. So when you combine those two vectors of our traditional execution and our transformation of the Acuity operating model, that has reflected in the year-on-year growth in our EBITDA margins from 21.7% to 31.2%. Granted, also in Q4 FY24, that was the first full quarter of Acuity coming into our numbers. So there were some integration costs, etc., one time as well that played into deflating the Q4 FY24 margins. But the bulk of it has come through the two levels of improvement that I just described.
So, Nithya, to take the conversation forward, can I say that for IKS, the new normal has moved from the margin window of 20 to 30? That is the new normal for IKS, Nithya, going forward, including the acquisition?
Including the acquisition, Nikunj, I think we have been vocal that we should be able to bring the margins up to the early to mid 30s level, and we are hoping to get there in the next 18 to 24 months.
But Nithya, 30% margin for any company on a historical basis, we've seen they do not sustain. Either the client would come in with cost rationalization or competition will start knocking on your door. If the TAM is so strong and if your margins are so strong, what about competitive intensity? Somebody would get up and say, oh, I want to do what Sachin and Nithya are doing, and that's where the margin starts reversing. How would you protect that?
Yeah, absolutely, Nikunj. And we are anticipating that. The reality is that our strategy accommodates for competitive intensity going up in this market. Like I was saying, $45 billion has been invested in what I call point solution companies that provide one or two tasks from our 16 task care enablement platform. And so, yes, at a task level, at an individual feature level, competitive intensity will go up. But our strategy accommodates for that. And the reality is that, one, we are the only company in the world that has built the full breadth of this platform. And what we are seeing in customer buying behavior is customers are getting tired of buying point solutions and buying tens of point solutions and then integrating them themselves. And so that buying behavior is slowly but surely graduating towards the platform. And given our leadership in the platform space, we are relatively optimistic about our ability to continue to peg away at our margins, like Nithya said, and move towards the early to mid 30s from the 31.2% that we have demonstrated in Q4. So I think it's embedded in our strategy of being the only company in the world with the full breadth of the platform, while we continue to be leaders in each of the features of the platform. So yes, competitive intensity to be expected to be increased, but that competitive intensity also reflects, Nikunj, the size of the opportunity. We are talking about a $225 billion TAM, of which only 30 billion has been outsourced so far. And the outsourced TAM of 50 billion is growing at 12%, whereas the $225 billion TAM is growing at 8%. So even as the competitive intensity increases, there's a lot of white space still to be captured.
Nithya, for any company to grow this kind of grow at this kind of rate, you need talent. And talent acquisition for Indian companies, we know at grassroots level has been a challenge. How would you ensure that in order to really capture this TAM, the total addressable market, you have enough and more manpower talent availability to ensure that you do not go off the track, Nithya?
So I think what Sachin has already explained is that over a period of time, we are trying to transform ourselves from human-led tech-enabled to tech-led human-enabled. So our focus is therefore to be able to attract the kind of tech talent that can continuously keep us ahead of the curve in each of the 16 features that we are working upon. So you will see that we are already employing about 460 odd technologists who are actually writing our technology. And our endeavor is obviously to try and make sure that we are keeping this pool healthy and we continue to invest. So what we're also doing is, in addition to, while a large number of these people we do draw from India's tech talent, we also have a small team in the Bay Area which supports our technology development. Sachin, anything you would like to add?
Yeah, the only thing I'll add is the reality is that we are people that supervise that technology to make sure that what it is producing is safe, because we're talking about healthcare and lives here. So we will always have a human element. And in this case, like, for example, we have 2,200 plus clinicians that we employ right now. And, we're doing some unique things to continue to be able to do that. For example, we've now created something called the IKS Cares Foundation that provides an avenue for our clinicians to actually practice medicine in a not-for-profit construct funded by our foundation to go and actually provide care to underprivileged sections of society. So now think about a clinician working at IKS has a dual life of being able to succeed in a fast-growing corporate world, but also stay in touch with the practice of medicine through their endeavors in the IKS Cares Foundation, for which they get paid separately. So I think we are, Nikunj, continuing to build unique models to attract and retain and develop best-in-class talent across the segments of clinical talent, like Nithya said, technology talent, and then to a certain extent, there is administrative talent that is required as well.
I'm perhaps saving the best questions for the last. And Nithya, the most obvious question is Trump and tariff. Tariff and Trump. Or Trump and tariff. Whichever way I want to put it, or whichever way you want to answer it. You can start with Trump first, or tariff first, or tariff first, or Trump first. Nithya.
I wish I had the answer, Nikunj, but I will tell you this. I think so far services has been exempt from any conversation around tariffs. So we feel relatively confident, therefore, in our ability to continue to grow. And some of the fundamentals remain true, even as the administration is trying to reduce healthcare costs. The fundamentals that there is still a lot of wastage in healthcare, there is still a lot that can happen, that lot that can improve in healthcare by bringing a lot more efficiencies. All of that still remains true. And we are happy that our business model offers a solution in terms of bringing those efficiencies to healthcare. So even as they try and figure out how to reduce healthcare costs going forward, we believe we are part of the solution, and therefore we look at this as a potential tailwind for our business model.
I've got lots and lots of questions, but I know I've extended my appointment already with you and you've got a packed day ahead. So we'll leave it there. But just to summarize, I mean, IKS has delivered solid numbers. It is not an IT company, so please don't look at it the same prism. And last time what we understood from Nithya and Sachin was the following, that it is a young company in a high growth sector, not a matured IT company, which in a sense is reaching what really be called as a mature curve. A young promoter, a young management. So think it like a startup, not like a mature IT company. So with that, good luck for coming quarters and thank you for joining us.
Thank you. Thank you so much, Nikunj.
Okay, that was Nikunj Dalmia on.
If you like this video, then like, share and subscribe to ET Now.